So immediately we kind of knew that we had a product that made sense, albeit for quite a small and specific market, but the growth was pretty pervasive and quite explosive.
I see a lot of really successful businesses. Key inflection points are these like strategic partnerships with big corporates that give them this massive distribution. And it seems like when I look at your business, you guys really did a lot of partnerships.
If anything, I think learning from mistakes rather than success. I mean, we sold too much of the business too soon. Incremental fundraising and really just taking as much as you need, I think, is absolutely critical if you wanted to kind of prime yourself for a successful exit and a big liquidity event.
The goal with Exit Strategy is to create an educational platform that helps business owners and founders develop skills that will help them get their businesses sold. David, welcome to the show. It's such a pleasure to have you with us here on the Exit Strategy Secrets podcast. I've been a big fan of yours. I've also used YouCook multiple times. I'm very excited to share your story today.
Yeah, thanks, Aaron. It's a pleasure to be here. Hoping the story's got some kind of tidbits in there that are useful.
So David founded YouCook. I'm not sure how many years ago. I think we'll get into that shortly. He exited YouCook to Silvertree Holdings. I think that was I can't remember, maybe 3 or something years ago. So David, maybe you can start off telling us a little bit about yourself and how you got into entrepreneurship and starting YouCook.
Sure. So I'm 33 years old. I started YouCook when I was 25. So kind of some time ago, I guess kind of entrepreneurship for me was largely brought about because I guess I didn't really want to kind of end up in a traditional industry. I don't want to use the word rebellious, but I kind of, dropped out of university after a short period of time and actually kind of traveled for, probably too long. And then, landed back in SA and didn't really have kind of too many job prospects. So it was either, kind of get a job as a restaurant manager and, hopefully kind of climb the ranks or do something entrepreneurial. Always loved food. At the time that we started YouCook, there was a lot kind of happening in the food media space. I mean, the rise of kind of Tim Noakes and everyone was going on a kind of banting frenzy. There was Yappy Chef, which was like this kind of e-commerce anomaly, selling fucking avocado holders and seemingly selling a lot of them. And Woolworths was kind of doing really well and it was kind of a technical recession. So, something that I guess like a recipe book that manifested the ingredients seemed to make logical sense. Did the whole startup thing, started out of a garage in Newlands. And, through lots of hard work and I guess plenty of luck, managed to sell it about 3 years ago.
That's fantastic. I know all about starting in a garage. That's how all good businesses start. But can you maybe just describe exactly what YouCook did and what it provided as value to the market?
Sure. So YouCook was a dinner kit service, I guess kind of modeled after the success of businesses like kind of HelloFresh and kind of Blue Apron at the time. We were very focused, I guess, on providing customers with I would say, kind of learning experience, which was maybe one of the kind of key points of differentiation. We were very, very partnership centric. We were, collaborating with all sorts of, fantastic kind of chefs and restaurants. So very, very marketing heavy. Every week there was a kind of new opportunity to learn from, one of your favorite chefs. We were also very focused on making kind of diets accessible. So, as mentioned, banting and, veganism was something that was kind of starting at the time. So really just making those diets accessible and affordable was another, I think, big benefit that I guess YouCook offered customers. It was initially started in kind of the Western Cape because I think trends tend to kind of start here and then stretch out across the rest of the country. So every week you could select a bunch of meals. We'd provide you with all of the perfectly portioned ingredients and recipe cards that would take you through that process. The business started, diversifying later on and ended up in a more kind of, I suppose, FMCG type space where, we sold frozen meals, we sold baby food, I think now we sell oranges and apples and kind of lemons and all sorts of other things.
Even
But
wine. I've seen wine on YouCook as well.
yeah, wine. I mean, to be fair, I'm reasonably disconnected from the kind of operations. So I don't know exactly what's on the menu in kind of any given week, but wine was always a big thing for us. It was a really big thing for us in that a big part of the value proposition was that you always ended up with kind of something free in a box. In fact, I think a lot of YouCook's success was owed to the fact that we managed to create partnerships with brands that wanted to specifically target the kind of affluent customer that was interested
Hmm.
in eating good food and drinking good wine. So it started more as a kind of campaign mechanism where we'd build menus around specific wine pairings, and then you'd kind of get the wine in the box for free. But I think now, as you've pointed out, you can kind of buy the wine as well.
Yeah, no, it definitely got me in the beginning, the free wine and the free things that you offered. So it was an excellent marketing strategy. We've recently partnered with Kaya Creative Studios, who are just helping us put this whole project together, making it seamless for us.
Partnering with Kaya really feels aligned to our mission and our integrity of our brand. They really do have a full array of podcast-related services and products. The Kaya team have the experience, they have the insights, they have the understanding and the full medium to really help a brand kind of grow.
If you're listening to the show and you're interested in starting a podcast or making it part of your branding marketing strategy, you should get in touch with Kaya. It's an excellent service. Hope to make some amazing content out there. So what were some of the key milestones, in your journey? Were there partnerships or revenue milestones or key hires that you made that took the business from kind of like, the startup kind of garage thing to, okay, we have an asset of value that, is producing cash? Maybe walk through some of those key highlights in your journey.
Sure. So if I think about like the kind of, I guess, major inflection points, it's an interesting question. I think, look, in the first, we saw I suppose the first kind of major inflection point was really when we built a proper kind of digital product. So, when our website was kind of seamless and it really worked. I mean, the initial kind of MVP was some hacked together WordPress, kind of Frankenstein that barely worked. And we kind of, I suppose, hobbled along for the first 6 or 7 months. We raised a very small, kind of menial capital round. I think 3 million rand was what we ended up raising kind of off the bat. And that allowed us to build a website, I suppose a customer interface that, did what it kind of needed to do. And, I guess it was kind of interesting in that we had this lag period whereby for almost 8 or 9 months, we were operating with absolutely kind of no real kind of income and very much kind of under the radar because we didn't have money to spend on kind of performance media and whatever else. But that allowed us to build up a substantial bank of recipes. When we kicked the business off, we had spent 8 or 9 months kind of in the kitchen, really just perfecting and testing a whole variety of different recipes. We got the prep time down to kind of 30 minutes. It was super robust, very, very kind of easy to cook. And we'd also, I think, worked out, at that point in time, what successful marketing within that space kind of looked like. I don't know if you recall, but there were these tasty videos, these videos where you'd have this top-down snapshot of a kind of recipe that was prepared in, 30 seconds, and you just see these kind of ingredients move through this
Yes,
very,
yeah,
very
I saw that. A lot of that on social media.
And so we kind of launched with those. We did one of those for kind of each one of the recipes, and so we had a little bit of success, I guess, via kind of Facebook. Instagram at the time wasn't really a great platform to kind of market through, and that was definitely an inflection point, right? As soon as we took on capital, we were doing 25 kind of boxes a week. I think in 3 months the business was kind of doing about 300. So very, very quick uptake. The recipes were pretty solid. And we had a nice kind of bank of them, even though we had low resource base at the time, we had 8 months to kind of build that up. So immediately we kind of knew that we had a product that made sense. albeit for quite a small and specific market, but the growth was pretty pervasive and quite explosive. So I'd say, post capitalization, we saw, quite quick growth, and you could see that there was definitely kind of something there. I think the next big inflection point was when we went from, obviously the Western Cape to kind of Joburg. There was a lot of, is this actually going to really work? I mean, Cape Town's all about, different diets, and they're kind of, in tune with what's happening, I guess, internationally. They're just more of a kind of cosmopolitan city. But Joburg was big. I mean, in 3 or 4 months, once Joburg opened up, it was kind of the same size as Cape Town. So that was crazy, right? We were doing, I don't know, 1.5 million rand a month at the time, and literally within kind of 2 or 3 months, we were doing 3. So that was definitely another big inflection point, because it indicated that the whole country was probably going to be interested in what we were doing. I think for me, if I look at other key kind of transformative moments, we onboarded and brought on a very, very kind of strategic partner at the time, which were the Smollens. The Smollen family are the biggest, they're the biggest, I guess, one of the biggest merchandising businesses in the world. But they onboarded a host of people that wanted to interface with us. So wine farms, guys that were doing a whole bunch of kind of different sources and whatever else, which really catapulted this big marketing movement whereby every week there was a new kind of product that people were kind of getting in their boxes for free. And that was definitely the kind of catalyst for, I would say, exponential growth, in that we went, over a kind of 2-year period, growing pretty kind of incrementally, a sale for base of about 4 million rand a month. We quite quickly grew to a business that was, 3 times that size. So that was also, quite big, really just solving for key access to I guess a group of consumer product brands within the food and beverage space that wanted access to this kind of premium customer cohort that we were interfacing with every week. So I guess moving YouCook from a business that was just a kind of dinner kit almost into a marketing platform that gave very specific access to kind of a key customer. And that was amazing, right? I mean, I think in the last year before we exited, just in wine alone, we put 30 million rands with a free wine in our boxes, So it was,
Wow.
and I think the business was doing, it was more than 10% of the total business's revenue. That was just wine. We had pestos, we had chocolate, we had salts, we had teas.
Yeah.
So that was another big inflection point, was kind of Smollen coming on board, investing capital in the business, and then also just providing access to a whole bunch of key partners that we could kind of campaign with.
Yeah.
And
Yeah.
then
I see a
obviously, I
lot.
think,
Sorry, no, I was going to say, just based off of that, I see a lot of really successful businesses. Key inflection points are these like strategic partnerships with big corporates that give them this massive distribution. And it seems like when I look at your business, you guys really did a lot of partnerships. You had your core product, but bringing on all these different brands, expanding your reach, using them for marketing, etc. It seems like such a key part of your growth strategy was, how do we find great partnerships, whether it's corporates, whether it's products, etc. It's like a very partnership focused business build.
Yeah, I think, look, I mean, I think if you look at the dinner kit, if you look at the kind of like operating dynamics of the dinner kit business, if you try to distill what's most interesting and what's kind of like best to leverage within that space, you've got this newness that happens every single week, right? Every single week, there's an opportunity to almost kind of build a different campaign, because there's a new set of recipes, and those recipes are, can kind of be themed. They can be associated with brands, with products. So you're right. I mean, I think that was definitely one of the major, I guess, kind of tailwinds that we had access to, was using the weekly menu to really, really kind of, hold consumer interest and build partnerships.
Yeah. So yeah, I want to kind of shift gears into the more technical stuff when it comes to, planning an exit and thinking about it. And I guess one of the first places to start is, when you set up your company, obviously you had partners, and then you said you brought on some capital. When you did this, were you and your partner or partners aligned on, we are building a business to exit? And then when you bring on capital, how did you structure the shareholders agreement in terms of like the plan for
Sure.
liquidation in the future?
So, I mean, to be completely honest, the initial, I guess, kind of like structure, I wouldn't say was completely kind of ideal. If the outlook was
Mm,
exit, and at the time, I think maybe there was as a kind of afterthought, there was a consideration around at some point in time, there would be some kind of liquidity event, but I don't think we went into it specifically considering a timed exit. I mean,
yeah.
the one thing that I think was worth maybe kind of mentioning that was useful within the UCook structure is that we built almost a non-dilutive management company whereby all of the kind of founding shareholders had a stake in, which owned the majority of the business. And then
Mm,
as time went on, in order, we didn't necessarily want to give up, control premium to our original investors, Silvertree. We actually raised capital in the management company. So the management company always ultimately had the kind of controlling stake. And that was structurally something that I think was kind of interesting, that made a lot of sense in that, we didn't ever dilute down beyond 50% as a kind of collective, cohesive management body. Like Smolin invested in that kind of side of, well, in that management company rather directly in the entity. But when we were setting things up, I mean, I wish I could say that, we were that we built we had, I don't know, all the kind of tricks of the trade. We
yeah.
most certainly didn't. I mean, I think we actually made real errors. I think if in anything, I can speak to, what not to do when kickstarting a business. We raised then what was a very, very kind of humble round, but we were, not exactly the most kind of credentialed management team. And in fact, I don't think anyone, including our parents, thought that we would make, anything of the business. And so we were very happy to we would take whatever we can kind of get. And I think we sold far too much of the business too early, right? I mean, the
Yeah.
first, we didn't really sell to be honest with you, we were largely non-dilutive, and we had a great cash conversion cycle in that we had kind of 60-day payables and all of our suppliers. And we were kind of just in time supply chain, right? We were only buying exactly what we needed to kind of sell the following week. And then we had kind of 2 months to pay, the debtors, and we were constantly growing. So we only raised twice. I mean, I think the total cash into YouCook was like 15 million bucks in rands.
Okay.
And I think
Okay.
the revenue at the end was around 250, given that it was COVID and it was a crazy period and you could sell, bloody packaged socks online and it would do well. But that was, if anything, I think learning from mistakes rather than success. I mean, we sold too much of the business too soon. Incremental fundraising and really just taking as much as you need, I think, is absolutely critical if you wanted to kind of prime yourself for a successful exit and a big liquidity event, where we sold 50% of the business in the first round. And
Yeah.
we could have probably raised $1 million, sold a whole lot less,
Yeah.
and then we would have raised substantially more when we actually had product market fit.
Yeah.
So
I
I
actually
guess
actually
that's
have a
kind of the learning.
similar lesson for our experience. When I was younger, I thought, my ego was like, you got to raise money, it makes you
Yeah,
look cool, and
yeah.
you must raise a lot of it. And I remember raising, $2.5 million. We didn't really need that much money. It was just like,
See,
that
now
seems
that
like
would
a
have
lot
been
of
great.
money. Yeah.
I wish
But the
I had
problem
raised
was,
$2.5 million.
the only problem was that we did it at a good valuation, so like almost like maybe a bit higher valuation than the business was probably worth from a fundamental point of view. But like the
Yes.
problem with that is it kind of just puts a lot of pressure on you, because now you've got the money and you've got this like pegged valuation. So now you
Got
have to
it.
basically use the money to grow the valuation to like double what you originally set it at, which was already quite high. So, and that's not easy to do because we didn't have like the clearest of plans. So I
Yes.
think it is interesting what you say. It's like, I think if I could go back, I would rather really only raise money once I understood exactly how I was going to use that in a value creation plan for shareholders, and not really just to raise it because it's cool to raise capital.
Yeah. Yeah. Yeah, I guess, sure, if someone had offered me $2.5 million when I was kind of 25, coming off the back of being a kind of English teacher in Thailand and the odd bar job,
Yeah.
I would have jumped on that. But the truth is, I think, very much, what you say, which is you want to be raising as little money as possible at every single juncture, specifically if you're wanting to kind of optimize for some kind of liquidity event in, the foreseeable future, because at the end of the day, you're gonna get what you end up with in equity. And also, I think, control is a very, very important thing to
Mm.
manage. You don't want to be in a structure whereby you're a kind of strategic minority in a business that you started and don't actually really have the ability to make kind of key decisions when it matters. And that became very problematic towards the latter half of kind of operating YouCook. If I'm going to be completely transparent and honest, is we almost had this kind of deadlock structure where Silvertree was, at 49%, the management company was at 51%, obviously myself and VC owning the majority of the management company, but we could never ever really we couldn't
Mm.
fundraise in a material way. We were looking at a much bigger round from NASPAS at the time, and we'd connected with I think Fabian, who was running their kind of foundry business
Yeah.
locally, and it was looking kind of really good. But Silvertree was going to block the raise because they didn't really want to dilute. They also didn't want to buy us, right? So I think setting yourself up for success right from the beginning is a very, very good consideration. One that I don't think most people are are really kind of paying too much attention to when they do kick a business off, right? It's really about like,
Yeah.
is this thing going to kind of succeed or fail? They're not planning meticulously for a inevitable future, because either
Yeah.
the number of businesses that go on to become legacy kind of dividend earners, I guess, are very, very few, right? It's kind of either
Yeah.
you're gonna sell it or you're not. It's gonna die. You know what I mean?
Yeah.
It's probably one of those
Well,
two things.
that's kind of
Yeah,
the whole point of this podcast, is that I'm finding that that's the case, right? Like, you start a business, you're either making money when you sell it, or it just like ends up kind of plodding along and then maybe even dying because competitors come in. So, I
completely.
think what you're
Yeah,
saying around, entrepreneurs, business owners need to plan their exits. It could be a 3-year build, it could be a 12-month plan, but if you kind of know, this is my road to liquidity. And then you align with your partners and your team and you assemble the right people to help you get there, you actually have a much higher chance of getting like a proper exit, because
yeah,
you're either selling it to like a strategic buyer who's looking to grow through M&A. Okay, cool. There's probably like 5 of those out there. You should already start building relationships. Or you're selling to a private equity firm that wants to buy your business and use it as a platform to scale it for 5 years. So
yeah,
that's a different kind of buyer, but you need to know what those buyers are looking for, and set up
yeah,
your product and your financials to kind of support their thesis.
yeah. Look, I think one of the things that's maybe interesting to kind of speak to there and is so Silvertree was, look, I'm friendly with both Peter and Manuel and Paul. Good guys, smart guys, managed to kind of do reasonably well before they kind of kicked off Silvertree. But if I'm just running the
Mm.
I guess the kind of like mental model of me at 25, I mean, there's definitely no universe whereby if I were to have played it forward, I wanted to be in a business for 15 years and slowly
Yeah.
kind of plod away at the hope of hopefully building something that was going to return kind of shareholder dividends. I mean, that was even now that feels crazy, right? So
Yeah.
I think the truth is their business model was kind of consolidation and really building this kind of like consumer internet vantage point that they could monetize in a more kind of traditional sense, right? Through consolidation. So there was misalignment probably right from the get-go, right?
Yes.
I mean,
Yeah.
we would have wanted an exit regardless, right? If we were fucking, wise enough to think about that shit when we were, 25, which we weren't. And
Yeah.
they didn't want that. And that really showed up as a kind of a bottleneck as kind of time, moved on. So it's a very good thing is having these conversations early with the people that you bring on, right? Creating that
Mm.
alignment right from the get-go so that you're all fundamentally ultimately chasing the same goal. You've got a North Star that creates the cohesion and the alignment, right? It also probably means that the way in which you you allocate capital and evolve the operation might be adjusted as well, right? If you're
Exactly. Yeah.
chasing an exit, maybe these success metrics are a little bit kind of different. You know what I mean? You're maybe not as kind of concerned about doubling down on, I guess, key things that you think might have value over, 10, 10 to 12 or 10 to 15 years. You want to make sure that everything that you're doing is going to create value upside over a much kind of like tighter time horizon, because ultimately
Mm.
that's when, the juice is gonna be, worth the squeeze. So
Yeah. Yeah.
yeah, yeah.
I also think having that mindset turns you as a sort of creative entrepreneur into more of a person who actually cares about the financials a lot more. Because, at the
Yes.
end of the day, valuation is going to come down to your financials and your last 3 years of financials. You look at the revenue, you look at the gross margins, you look at the
Yes.
net profit, and you ultimately come up with a thesis on valuing this company on EBITDA. For people who don't know what EBITDA are, that's your earnings before interest, tax, and amortization, and it's probably the most common form of valuing a business is a multiple of EBITDA. So, private equity will come in and say, great, you've got a great business, we'll pay 4-5x EBITDA, which ultimately means that they're paying for 5 years of cash flow profit. They're giving you the money, and how, depending on how professionally run and well set up your business is for scale, that multiple can be higher. It can be 10, it can be 15, but in general for small businesses it's like 4 to 5. But I think founders are not looking at that number every year and going, okay, well, like, how do I optimize my EBITDA? How do I make sure that it's growing? How do I tighten and expand my margins and grow my revenue at the same time? I mean, that's like a financial engineering sort of equation versus like this, hey, let's build a new product and let's hire this person type of thing.
Completely. I also think maybe just on that point, because it's an interesting one, right? So like YouCook never made any profit, right? We grew, look, we grew fast, and we grew fast with very limited capital. So I think in terms of kind of
Mm,
e-commerce, which is a model that's debatable. If we're going to call a spade, I mean, I think the number of e-commerce companies that are profitable are very, very kind of like few. You really need kind of immense scale and real market density, I think, to make the numbers stack and businesses like that work. But the truth is when you're kicking off, right? And this is maybe an interesting kind of just point to kind of drill into. If you're speaking to entrepreneurs at the inception of their journey who are really kind of testing different operating models and experimenting hypothetically with things that they think make sense within the specific market that they're wanting to operate in, one of the things that you're mentioning now, which I think there's always these cycles, right? Where we go through these cycles whereby you've got these crazy, periods of hype. Like we were in a bull run, I don't know, 3 years ago for like 12 years, where there were just all these models that made absolutely no economic sense, right? They're very quick to kind of grow revenue, very quick to go kind of like, customer access, but struggle to make margin, right? Struggle to actually return capital to the investors. And if we look at the current climate, right, which I think we've had some sense shaken into the current kind of
yeah.
economic climate globally, you should be prioritizing more fundamental metrics that actually speak to the kind of economic potential of a specific business, right? And that, like you said, that is EBITDA. That is the things that will always intrinsically hold value, right? Like you can always sell a business for some kind of multiple on its return. It's much harder, specifically in a climate like the current climate, to sell a business on slightly more superficial commercial metrics. And I think
Yeah.
that's important, when you are actually kind of starting something new. Yeah.
Yeah, the economic climate's changed totally. And I think the number one reason for that is obviously interest rates. Obviously before 5, 6, 7 years ago, they were quite low, which means that, private equity, venture capital had cheap access to capital. And therefore, that capital could be pumped into growth. Whereas now with higher interest rates, it's harder to get access to big blocks of capital and to deploy it, and you need to get a good return on it to make it worth it. So I think fundamentally there's been a big correction. And like you say, good old fashioned business that has growing revenue and good profits is what people are now excited about. I think the technology has also become a bit of, everyone's making a new AI tool, or everyone's making a project management tool, and these things, there's just too much competition. We need things that are going to give value to consumers in the climate that we're in, I think.
Completely. Yeah, couldn't agree more.
So a little bit more detail on your exit process. So at what point did you guys go, okay, we're ready to sell? We've been doing this. How did that transpire?
Sure. I would say opportunistically, right? I mean, again, to be completely frank and honest, I think I wish we were a business that was very, very, we didn't have a specific kind of target date. I mean, I think it was always going to be tricky given the kind of almost, stalemate that we had from a kind of cap table perspective. Silvertree would never have wanted to sell YouCook. It was one of its better performing assets. The consolidation of Cyberseller, Faithful to Nature, and YouCook was always something that they were kind of hugely interested in. So I guess the sale or the liquidity event was always going to be tied to Silvertree receiving a kind of capital sum that would allow us to buy out the management team. So we were always going to be waiting on that, right? And I think really, it was a very, very, it was, well, arguably one of the worst, economic blips in the history of the world. In that kind of, COVID just wiped out a lot of kind of traditional industries, and a lot of guys really, really struggled kind of over the course of that, and we're still seeing the, I guess, ramifications of kind of COVID now. But for us, it was amazing, right? We had the business was doing very well leading into COVID. We had a fantastic year of growth. We introduced a bunch of new products. We had also branched out into, I guess, a more, FMCG kind of centric strategy, partnered with Pick and Pay, opened up frozen meals as a new kind of revenue stream, which was starting to kind of had some other interesting partnerships in the pipeline. We were going to just about to launch baby food with Made For. So it seemed like, YouCook's growth prospects were strong, diversifying, not just sticking within the dinner kit space. And then COVID was great. I mean, we had a huge spike in revenue. As Silvertree, obviously, there's not really many big, I guess, e-commerce stables in SA, and they were one of the bigger ones, given all of the businesses that they're involved in. They managed to raise a good sum of money, and that was what triggered it, right? And they gave us I would say, it was a reasonably fair valuation at the time. I think it was $12.7 million or $12.4 million, I think, was the end number that we ended up selling at.
How did that number come? I'm sure that the valuation is always a tricky topic,
Sure.
and that requires a lot of conversation, negotiation. Because
Yes.
obviously you want the highest valuation, they want the fairest valuation. You've done a lot of work, you've put a lot of effort.
Yeah.
Can you talk through that the valuation process as well as the negotiation to where you finally landed up? How did you do that?
Sure. So I think the valuation for, the valuation really was always going to kind of be down on some kind of revenue multiple. Obviously, the business had been chasing top line, since its inception, right? It was just kind of chasing scale. So it was always going to be, the consideration was always going to be some kind of revenue multiple. I mean, we would have loved to have seen a kind of 2x revenue multiple, which, I think would have been, look, given what we were doing at the time, and the kind of influx of demand, and the fact that we didn't really know where COVID was going to be ending, I think that would have been fair. We ended up at around 1, at that kind of time. And it was very, very kind of, look, again, we were close, right? I mean, the management, the investors, to an extent, were a lot more, I would say, kind of operationally involved in the business, right? I mean, Pete at that time was working with me in YouCook. So it wasn't it was it was a little bit of a smoking gun in that I guess, I either wanted the business to take on real capital. I wanted to raise, 10, $20 million and have a go at a much bigger space, which was the kind of emerging quick commerce space at the time, which I still think would have been a good strategic move for YouCook at that point, because there wasn't any really established player that was doing kind of real volumes yet then. And obviously, it was an interesting opportunity globally. Or we wanted a liquidity event. So I think Silvertree was definitely feeling the pressure from the management team. We were collectively, all with consensus kind of aligned on wanting to exit the business if we weren't going to take on a big kind of capital tranche. And Silvertree just wasn't interested in moving the business into a new space and potentially losing control to a bigger entity, over the course of time. So I think opportunistically is the answer to the question. There wasn't any material. I guess the cadence that made sense was that we were mid-COVID, right? And COVID was obviously the great adjuster in the e-commerce universe. So yeah, I don't know if that answers your question. It's hard for me to give insight into timing and sequencing and negotiation, because I don't think it was orthodox in the way in which it kind of came to be.
Yeah, look, I think the difference in your situation maybe to a traditional business that's looking to exit is that you had a partner that was already, going to probably buy you out in the end. So you didn't go to market with your asset and, look at potential buyers and then, kind of find the one with the best valuation and the best structure with an earnout or something. So it is quite different, but, I think it's still relevant to people who are thinking about bringing on capital partners and how that might play out over time. And really understanding, like you said earlier, is that alignment. Did you have specific legal counsel or tax counsel as you went through this process? Because that's also quite a demystified or mysterious, sorry, not demystified, a mysterious part of a sales process. It's like, okay, well, now I have to sign a lot of documents and I have to pay tax on things. What was your experience with the legal and tax side of things?
So it's a good question. It's a good question. We did get some expert tax advice from a guy called Dr. Hupt, who's a kind of doctor of tax and probably essays kind of authority. So it was interesting in that we actually kind of opted to pay, so that the payout was over 2 years, and we were able to save incrementally on the, I guess, capital sum. Look, what we should have done, which we didn't do, is probably set up have held our shares in a foreign trust. We held all of our shares kind of locally, which was, I mean, look, it was 18% in the end. We got the kind of gains rate, the effective kind of gains rate. But had I known what I do now, I mean, in my new business, my structuring is very different. I wish I had, offshored that, because the sum in the end was quite substantial, and that, it was a few $1 million, and I mean, that's also tricky, right? Because you don't want to be paying $15,000 a year, as a kind of early stage founder that's not really making a ton of money, in the hopes that at some point in time you might kind of save on tax. But sure, tax gets you. For some of the guys that weren't founders, and ended up with options, the tax kind of event was really, really material. We got some good legal advice. I think we were working with kind of Bowman's at the time. It was a pretty traditional, I would say, buyout. We didn't have any kind of stringent performance controls in that. I think I went, I guess, in exchange for a kind of straightforward and clean transaction with no kind of performance earnout, we kind of sacrificed on the initial sum, which, to be honest with you, I think was actually a very good decision, right? There was alternative deal we could have taken at a slightly higher valuation, maybe 25% up. But then there was an earnout over 3 years. So we would have seen an increase in what we would have got in terms of share sale. But then we were tied to operating the business for another 3 years and making sure that we at least held at those kind of revenue levels, which lo and behold, COVID came and went, and suddenly e-commerce wasn't the definite future.
Yes.
I think everyone
Yeah.
in e-commerce thought that we were on the precipice of a commercial evolution. No consumers are going to go back to stores. Now we built the behavior. I mean, it's absolutely nuts. So
I
look, we
had
made
exactly I had exactly the same experience in education. I mean, obviously our travel business died with COVID, and that was quite scary. But then we built the online education, and kind of everyone was like, "This is the future," online education companies to you, etc. Shares like, 300% up in like a couple months, and Zoom, etc. And now those stocks are dead. They are literally dead. Like people were saying, education is completely changed. It's like now everyone's just back in class, like going back to traditional old classrooms. And it was quite an interesting time. I think it accelerated a lot of stuff because people were forced to innovate. They had no choice, really. You just had to. And I think the technology of, video streaming, etc., was rapidly improved, which is, I think, a great thing for just business and in general. But I think behavior was like spiked in a different direction and then kind of normalized again.
Did you so is IX now, is it as experiential, as physically kind of experiential as it was?
Yeah, look, our travel programs brought in a lot of revenue. I mean, pre-COVID, it was like four going on to $5 million, which we lost everything in kind of like 3 weeks. And we always had to close the business down, but we were able to build these kind of premium online programs, which we were charging $6,000 for. And what was really nice about those products is that the margins were much better. They were like 80 to 85% versus 65% on the travel programs. But we struggled to get as much traction because it's like not as sexy and the market's super competitive. But now we've brought back travel, and it's grown to like kind of what it was pre-COVID. But we now also have this online business, which I think we'll get to about $1 million of revenue this year. So it kind of helped us build it helped us build like a new part of the business, which is pretty cool. It kind of like made our brand a bit weird because we were always about experiential learning and like, being out there and getting out of your comfort zone and having these experiences. And now we're like, yes, and we also have these online programs, which kind of doesn't.
If you don't like that,
so it's like it's made our whole like mission and brand like slightly confusing. But ultimately we've come down to, we just help college students build better careers through experiential learning. They can do it abroad, they can do it online. But yeah, COVID was interesting. Everyone I've spoken to on this podcast is 2 people actually so far. This is the 3rd episode. But has been like, there's been like a significant like event during COVID that like monumentally impacted their business,
Good or bad. Yeah. Either catastrophic or this kind of like godsend. No, I mean, makes a ton of sense. Also, just interesting. Sorry, just hugely a little bit diversion, but interesting. Do you think that because of all of this new technology that's just really starting to emerge now, and it's very much becoming kind of pervasive within the digital space, do you not see the digital learning format becoming more experiential and immersive in and of itself? What's your view on that? You know what I mean? And again, I mean, I skirt around, listen to the odd kind of podcast and ingest a little bit of information online. But VR, AI, how does that impact online learning?
Yeah, look, I think in my view on education has always been simple. Like I studied at Yale and spent 4 years there. And to be honest, like I thought it was pretty average in terms of like the classes, the teachers, what I learned in 4 years. I was pretty dedicated, studied engineering, and I basically walked out of there with like pretty much no knowledge. I had a great college experience, but I didn't learn relevant topics in a inspiring
Yes.
environment. And the whole point of IX was like, okay, well, these people want to learn. I mean, if fundamentally every human being wants to learn and be successful, and if you can set up the right environment, and the right environment for me is like, we get industry professionals to teach the courses. We combine it with real world experience so that you can like apply it in the real world, actually understand it. And we do
Yes.
it at a very high pace, so you're learning fast, And I think when people see progress, and if you want to learn Portuguese, like, and you've never spoken it, yeah, probably in 2 months, if you really immersed yourself in it and you're in the country, you could probably learn it. And I think
Yes.
humans forget that they can learn a lot in a short period of time at high speed, and that's always been our philosophy. And then we kind of wrap it with like a great environment where people can connect and be part of a community, because I think traditionally, learning environments, you need to be part of something. And I think that's where online learning just fails. Like you go and you try to do
Yeah.
an online course and you're just like watching and watching, and halfway through you're like, oh, but like, I'm bored now. It's all about the conversation. It's about being part of something. It's about growing together. And
Yes.
that's what you want. You want to be in a cohort. You want to belong to something. After the program, you
Yeah.
want to call someone and be like, that was cool, like, let's do something together. That's why business school, even though, the education's not maybe as good as what it could be, it's like people really belong to this class, and they
Yes.
stay in touch for like, their whole lives. And that's what IX is really about. It's like, becoming part of this community and learning at rapid pace and improving your career prospects.
So in essence, I guess you know, so some of the key, distillations being, um, even though you've got all this interesting shit that's happening in the online kind of like the online, I don't know, terrain, more broadly speaking, in terms of like consumer interfaces, it's you don't see that actually ever fundamentally displacing the
I
need
don't
for
think so.
people to to
I
to
don't think so.
learn, to actually kind of be. What's interesting, because for me, again, I can only speak about it anecdotally, and I guess like the kind of emotional experience, um is recently I went to Sri Lanka and I did like a 10-day kind of surf like camp thing.
Yeah.
And I've tried
Yeah.
to surf here in Musenberg and I suck. You know what I mean? Like
Yeah.
I've always envisaged myself as this person that was at some point in time going to learn to surf. And your progress is always kind of stunted because, when you're not part of this kind of like collective, right? There's a whole bunch of different, like, I guess, factors that feed into why that learning environment is almost kind of elevated. One is, there's almost like you're just naturally, there's a little bit more of a pressure cooker, right? Like you're kind of there. There's a dedicated kind of purpose. You're able to almost kind of clear out the mental clutter, and you're not,
Yeah.
you don't kind of
Yeah.
procrastinate, make excuses. You're almost a
Yeah.
little bit more, almost kind of mentally kind of connected to what you're actually wanting to achieve, right? And then
Yeah.
and then I think there's just something that's really, really exciting about group learning. Like, and I don't
Exactly.
actually really know what it is, right? But if I were to sit down and talk to an independent kind of surf coach, and I was sitting on the sands of Musenberg, and he was fucking, I don't know, giving me the do's and don'ts, I just don't really think I'd like be paying that much attention to the
Yeah.
independent person. But suddenly, when you're in this kind of like group session, there is this almost like tribal type.
Yeah.
I don't know. There's something there, so I totally hear that, and it's interesting. Interesting.
Yeah, no, that's my philosophy 100%. And, even part of like this exit strategy business that I'm building, it's an education
Yes.
process. And what I want to do is get 30 founders, business owners together in a room and spend 4 days learning the art of exiting your company together. Going, okay, let's look
Yes.
at the financials. Like, how do you actually fix this? Okay, David, let's talk through your experience. Okay, John, like, why are your financials looking like this? Okay, let's talk about, you know, your recurring revenue. How does that work? And like, how do you position, like, the whole thing of doing this together and then helping
Yeah.
in 4 days completely transform someone's mindset into, hey, I've built an asset of value. I can sell this thing. I can get it at 5x multiple instead of 3x multiple. I mean, that's like millions of rands of difference, where it's like
Yeah.
the kind of Tony Robbins style, like a lot of
Yes.
really successful business people, they do these 4-day mastermind events. They'll go and they'll do like a Tony Robbins, or they'll do or whatever, and they'll come back and they'll just be like, holy shit, like I'm the best at what I do, but I still love these events because there's something
Yes.
that changes, something that happens. It's like a shift in your mindset that like you can get. And I think we actually lack that in South Africa. You know, it's a big thing in America. It's like it's a pretty big thing. These masterminds.
Yeah. No, I agree. Look, I think it's necessary. I also think, just one thing on the exit stuff. I think one of the things that's also interesting within the context of, and we're doing it now, right? So new business, we raised a, substantial pre-seed, about 12 months ago, operating in the kind of off-price space, using some kind of technology really to modernize an existing industry. Really, really great economics, makes a ton of sense of the market. Already now, just feeling like, I don't know why I didn't make the kind of decision earlier to focus on businesses that just make, economic sense. And one of the things that we're doing, because we're like, okay, shit, we do want to build it to exit this. We want to, sell this thing in 8 years. We think we do 500-600 stores. Is starting to flirt with potential, like acquirers, right? It's making sure
Yeah.
that you're
Yeah.
doing a good job of
Top of
actually,
mind.
yeah, exactly. How do you actually infiltrate the environments of people that could at some kind of given point in time acquire your business, right? Is it by getting on board a senior executive who is works at one of the kind of like key companies that you might end up
Yeah.
being acquired by, bringing them on board as a board observer or an advisor? And I think it is an art, right? There's definitely a science/art. I think, probably both, right? Financial science, and then also maybe a little bit of, behavioral kind of social art around building a strategy that gives you not just the best chance of exit, but also, the best, value. So, no, super interesting.
Yeah. No, absolutely. There's a sales element to exiting a business. I mean, you're selling something. It's like you've got to tell a story. You've got to build your brand. Like all the little things matter, and they kind of add up at the end of the day. So that's why I say if you started early, okay, 12 months, 24 months, 36 months down the line, I'm starting now. You will have a much better result. There's a
Yeah,
roadmap for that.
yeah, yeah. Completely,
What
man.
is the actual current business that you're working on? I've looked at it a bit, but maybe a brief description of exactly what it does.
Sure. Um, Very simply, so obviously there's a huge kind of global I suppose textile pandemic, in that roughly around 20% of the clothes that are produced every year end up not kind of being sold. A portion of those clothes are destroyed. Around 25% of those clothes end up being incinerated or dumped. And then the rest are really sold into kind of outlets like TJ Maxx, or consolidators that kind of ship them around the world. We're building a emerging market outlet strategy. So we're focusing on building stores here. We use technology to improve sell through, just a little bit more of a kind of informed both buying, planning, and now also kind of pricing process. Really, the thesis is simple. Big brands don't really want to sell their overstock, so last season's goods, into primary markets. So a lot of the guys, Interdex is a good example. We buy product from Zara, Pull&Bear, Bershka.
Mm,
They don't
mm,
sell any of their product into global outlets just because they cannibalize or disrupt themselves. So
yeah.
emerging climates like South Africa, climates like Brazil provide the perfect opportunity for us to buy up product at between 5 and 10% of retail, branded goods, and sell them in environments where there's no full price opportunity for brands. I mean, I think Interdex has 8 stores in Africa. It's got kind of like 4,600 stores in Europe. So
Yeah.
we're selling branded goods in I guess Africa to start, but probably end up in South America over the next little bit of time. There's also a big kind of environmental proposition in that if brands can't offload the goods into markets where they're not kind of cannibalizing trade, then they end up destroying them, which is obviously a big environmental
Mm.
concern. It's something like 2.1 billion garments every year end up getting burnt. So crazy
Wow.
stats.
This is crazy industry. Wow.
It is, man. But yeah, I mean, incredible economics. I mean, we launched not very long ago. We did 2.5x, I guess, revenue in off the last store opening. We did our month's trade in the first weekend we were open. So I mean, it feels really, really
Insane.
good in this climate. You've got, some of the best brands in the world trading at 60-70% off, and we're making kind of a 55% GP at, at
Yeah.
that kind of price level. Yeah, so we're doing like a store a month now. We're in the process of raising a bigger round from some kind of global guys. Hopefully looking to try to do 20 to 25 stores next year. We'll probably get to 8 this year, but yeah, really, really good, really good. We'll be profitable within 12 months. So again, very
Amazing.
different to previous
Very different to
business.
YouCook. Yeah.
Yeah,
The
yeah.
growth of
You
an
cook is
entrepreneur.
sure. Yeah. And also, I mean, look, I mean, probably, it's not part of any hype, uh, hype train. We're looking at, something that we think makes sense at scale in this market,
Yeah.
which
Yeah.
is also, I think, something that is not really considered often by entrepreneurs when they kick off, deep consideration for TAM is almost always a miss in the kind of early phases of starting a business. And I think it's probably the most fundamental metric, right? Is how big can you actually,
Yeah.
how big
Yeah.
can you really build the business? And even now, obviously different business I'm involved in, we're needing to go abroad just because we've kind of almost
Yeah.
choked up what we
Yeah.
can in this market. So yeah, Faro, exciting, feeling really good about it. Very
Yeah.
early, but good signs.
So exciting, bro. Loving watching the journey, and I really appreciate all the lessons that you shared today and the insights. I know it can be like, it's quite a process thinking back on, all of that. And I think,
Yeah,
in the time
yeah.
you're like, oh my God, there's so much going on. It's so important, all these things. And then when you look back at it, like, you're like, oh, wow, okay, that happened. That was quite an event in my life.
Yeah, man. No,
Yeah.
thank you so much for having me. That was great.
Yeah, I appreciate it. I see you out in YouCook. You got a beautiful view, nice, serene. I'm definitely gonna come and visit you out there, and we can do
Well,
some thinking. Two entrepreneurs together is always a dangerous thing, You walk away from a lunch with like 50 ideas that you've got lined up. You feel
completely.
inspired, and then you're like, what are we actually gonna do after this?
Exactly.
Yeah. Yeah. All right, man. Well, thanks so much, David. I will chat to you soon and appreciate it. And if anyone here who's listening wants to get in touch, I'm sure you can pop David a message on LinkedIn. I'll leave his LinkedIn details in the show. And yeah, let's just keep learning.
Cool, man. Cheers, Aaron. Have a good day.
Right.